The biggest investing mistake isn't choosing the wrong investment. It's spending months or even years searching for the perfect investment before taking your first step. That's where countless people get stuck. Here's what most beginners don't realize. The hardest part of investing isn't the money. It's the moment right before you begin. And strangely enough, that moment feels almost the same for everyone. You download a brokerage app or visit a financial website, and suddenly you're surrounded by unfamiliar terms. It feels like you've walked into a conversation that already started and no one stopped to explain the rules. Imagine someone sitting on their couch after work, finally deciding, okay, I should start investing. They open an app, tap Create Account, and freeze. Not because anything is broken, but because they're asked to choose something they don't understand. So they close the app and promise themselves they'll come back after learning more. That later quietly turns into weeks, then months. Not because they're careless, but because no one showed them the first safe step. That's where most people give up before they even begin. The truth is, successful investors don't start with complete knowledge. They start with one small action before they feel completely ready. Most people don't avoid investing because they don't care about their future. They avoid it because the first step feels uncertain. And when something feels uncertain, it's easy to keep postponing it. If you've ever felt overwhelmed by investing, you're in the right place. My goal isn't to bury you in financial jargon. It's to make investing simple enough that you can confidently take your first step. But before we go any further, we need to answer one important question. If saving money is considered responsible, why do so many people who save diligently still struggle to build real financial security? That's where everything starts to change. For many people, saving money feels like the responsible thing to do. It's calm, predictable, safe. You check your bank balance, see the number sitting there, and it feels like nothing can go wrong. But let me show you what that safety can look like over time. Imagine you saved $10,000 and left it untouched for years. You don't spend it. You don't invest it. You simply keep it there for your future. At first, nothing seems different, but then life starts moving around it. A grocery trip costs more than it used to. A weekend getaway becomes harder to afford. Even everyday expenses like fuel, coffee, and subscriptions quietly become more expensive. The number in your account hasn't changed, but your life has. That's what many people don't notice. It doesn't feel like you're losing money. It feels like everything else slowly becoming more expensive until your savings no longer stretch as far. Here's the key idea. Safe doesn't always mean smart over the long term. There's another layer to this. Every place you keep your money is also a decision about what it won't become. Money sitting in a low-growth account isn't just standing still. It's missing the chance to grow elsewhere. Like watching a train slowly leave the station while you remain on the platform. You haven't moved backward, but you haven't moved forward either. That's opportunity cost. This is why many people eventually change how they think about money. They realize it's not just something to store. It's something that can grow with time. And once you see that, the next question becomes obvious. What should you actually do with your money? That's exactly what we'll explore next. Now that you know why investing matters, let's answer the question almost every beginner asks. What are you actually buying when you invest? Imagine you're given $10,000 and two choices. In the first, you invest every dollar in one company. At first, everything looks great. The company is growing, the news is positive, and your investment rises. Then things change. Sales slow down. A competitor launches a better product. The business struggles, and because all your money is tied to that one company, your investment falls with it. That's what owning an individual stock means. Your financial future depends on one company, one team, and one story. Now, imagine a different approach. Instead of buying one company, your $10,000 is automatically spread across hundreds of businesses. Some grow quickly, some stay steady, others struggle. But because your money is diversified, one company's bad year has only a small impact on your overall investment. You're no longer depending on one story, you're benefiting from many stories unfolding at the same time. So how is that possible? Instead of buying companies one by one, you buy a single investment that already contains many of them. This is called an ETF. Think of it as one simple package that gives you instant diversification. Many ETFs simply follow the overall market instead of trying to beat it. These are known as index funds. Rather than predicting which companies will win, they grow alongside the market over time. For beginners, that removes one of the biggest obstacles. You don't have to guess the next winning company. You simply own many companies, stay invested, and let time work in your favor. Next, we'll look at other investment choices and how they compare. When people first learn about investing, it can feel like they're reading a menu in a language they don't understand. Stocks, ETFs, index funds, mutual funds, bonds. But once you strip away the jargon, investing becomes much simpler than it looks. Let's start with mutual funds. Imagine you and thousands of other investors pool your money together and hand it to a professional manager. Their job is to decide what to buy, what to sell, and how to beat the market. That sounds reassuring, but here's the catch. Professional management comes with higher fees, and over long periods, many actively managed funds don't consistently outperform low-cost index funds after those costs are taken into account. Now, compare that with ETFs and index funds. Instead of trying to beat the market, many simply follow it. If you invest in a broad index fund, you're buying small pieces of hundreds of companies all at once. No guessing, no constant trading. Just broad diversification, low costs, and time working in your favor. Then there are bonds, which serve a different purpose. Instead of owning part of a business, you're lending money to a government or a company. In return, they agree to pay you interest and repay your original investment later. Bonds usually don't grow as quickly as stocks, but they tend to be more stable when markets become unpredictable. When you step back, most portfolios are built from just 4 simple tools. Stocks own individual companies, ETFs and index funds own many companies through one investment. Bonds provide stability and steady income. That's it. Once you understand these building blocks, investing becomes far less intimidating, and you're ready for the next important decision: where to hold your investments. Before deciding what to invest in, there's one question that quietly shapes your long-term results. Where should your investments actually live? Imagine 2 people, Alex and Jordan. They earn the same income, invest the same amount, buy the same index fund, and earn the same returns. The only difference is the account they choose. Alex invests through a regular taxable brokerage account. As the investment grows and earns dividends, taxes gradually reduce how much of that money can continue compounding over time. Jordan takes a different approach. First, Jordan checks whether their employer offers a retirement plan with matching contributions. It does. So Jordan contributes enough to receive the full match. That's an immediate boost to the investment before the market has even done anything. Next, Jordan opens a Roth IRA, a U.S. retirement account that allows qualified withdrawals in retirement to be tax-free. Starting early gives decades of growth without future taxes, reducing those gains. Fast forward 30 years. Even though Alex and Jordan invested in the same fund, Jordan ends up with significantly more money, not because of better investing, but because of better account choices. That's why choosing the right account matters. If your employer offers matching contributions, that's usually the best place to begin. After that, many U.S. investors consider a Roth IRA, then continue investing through retirement plans or a regular brokerage account. If you live outside the United States, the account names may be different, but the principle is the same. Some accounts help your investments grow more efficiently through tax advantages or employer benefits. Choose the right account, and you remove obstacles before your money even starts growing. Next, let's look at how to choose the right investment company to hold those investments. After choosing the right investment account, the next step is selecting a brokerage, the company that lets you buy, sell, and manage your investments. This decision often feels much bigger than it really is. Many beginners spend weeks comparing platforms, reading reviews, and worrying they'll choose the wrong one. In reality, most well-established brokerages offer everything a long-term investor needs. Instead of searching for the perfect platform, focus on low fees, ease of use, reliable customer support, and features that make investing simple over time. Imagine choosing between 2 trusted brokerages. Both offer the same investments, but one feels clean and easy to use while the other feels confusing. Chances are you'll stick with the one that makes investing feel effortless. But there's another question many beginners quietly ask. What happens if the brokerage shuts down? Will I lose everything? It's a reasonable fear, but it isn't how the system works. When you invest through a reputable brokerage, the investments belong to you, not the brokerage. Think of the brokerage as a secure storage service. It holds your investments, but it doesn't own them. Even if the company experiences financial trouble, regulations require customer investments to be kept separate from the brokerage's own money. That means your ownership is protected. The real risk in investing isn't losing your assets because the brokerage fails. It's normal market risk, the fact that investments naturally rise and fall in value over time. Once you understand the difference between market risk and ownership risk, investing becomes much less intimidating. At this point, you've removed most of the fears that stop people from investing. Now, there's only one question left. What should you actually buy first? Now that you've chosen an account and understand how brokerages work, you've reached the point where many beginners freeze. You open your investment app, type a few letters into the search bar, and suddenly hundreds of funds appear. Some focus on technology, others promise dividends, rapid growth, or international exposure. It feels like you need to understand every option before making a decision. The good news is, you don't. The answer is much simpler than most people expect. For most beginners, the smartest approach is to start with one broad, low-cost index fund. Instead of trying to predict which company will outperform, you're buying a small piece of hundreds or even thousands of businesses all at once. Think of it like owning a tiny piece of every major business in a city instead of trying to guess which single store will become the most successful. You don't need to pick the winning street. You own the whole city. In practice, many investors choose a fund that tracks a broad market index, giving them instant diversification with very little effort. As your confidence grows, you can always expand later by adding international funds or bonds if they fit your goals. But here's the idea that matters most. Your first investment doesn't need to be perfect. It just needs to be started. Trying to build the perfect portfolio on day one usually leads to analysis paralysis. Starting with one diversified fund lets you participate in the market while you continue learning. Successful investing isn't about making dozens of complicated decisions. It's about making a few smart ones and staying consistent over time. Next, we'll build a portfolio that matches your age, goals, and comfort with risk. Once you've decided what to invest in, the next question is simple. How do you put everything together into a portfolio? The answer is that there isn't one perfect portfolio for everyone. The right mix depends on your age, your goals, and how comfortable you are with market ups and downs. Imagine Alex, who is 25 and just starting a career. Retirement is decades away, so time is on Alex's side. Because there's plenty of time to recover from market declines, the portfolio may focus mostly on diversified stock funds for long-term growth. Now imagine Maria, who is 60 and planning to retire soon. Growth still matters, but protecting what she's already built becomes more important. That's why her portfolio may include more bond funds to reduce volatility and create greater stability. Same market, same investment tools, different portfolios, because the goals are different. A simple way to think about this is a balanced meal. Stocks provide the growth, bonds add stability, and international investments bring extra diversification. Each plays a different role, and the goal is balance, not complexity. As your needs change, your portfolio can change too. Some investors eventually add international funds or even real estate investments like REITs, but those are optional for beginners. The biggest mistake isn't owning too little. It's owning too many overlapping investments that don't add meaningful diversification. A simple portfolio that you consistently contribute to is usually far more effective than a complicated one that's constantly changing. Remember this? A good portfolio isn't the one with the most investments, it's the one that matches your goals and the one you can stick with over time. Next, we'll answer one of the biggest beginner fears. What happens if the market crashes right after you invest? By now, you understand how investing works, but one obstacle still stops many beginners: fear. The biggest question is usually, what if I invest today and the market crashes tomorrow? The honest answer is simple: it absolutely could happen. Imagine you finally invest for the first time. You feel proud for taking the step. Then the next morning, you check your phone and your portfolio is down 8%. Your first thought probably isn't, "This is normal." It's, "I made a mistake." But that's exactly where experienced investors think differently. A market drop doesn't mean you made a bad decision. It means you're experiencing something every long-term investor experiences sooner or later. Financial markets rise and fall. That's normal. Short-term volatility isn't a sign that something is broken. It's simply the price of long-term growth. Think of investing like a long journey through changing seasons. Some days bring clear skies, others bring storms, but changing weather doesn't change your destination. Market declines work the same way. They're temporary, even when they feel uncomfortable in the moment. Another common fear is choosing the wrong investment. But if you're investing in a broadly diversified, low-cost index fund, the bigger mistake usually isn't picking the wrong fund. It's waiting forever to find the perfect one. Then comes another thought. Maybe I'm too late. But investing doesn't reward perfect timing. It rewards consistency. Every generation has experienced crashes and uncertainty, yet patient investors have historically been rewarded over time. So ask yourself this instead. Will I be glad I started 10 years from now? A temporary decline doesn't erase your progress. It simply reminds you that investing is a long journey. And fear doesn't have to decide when you begin. One of the most common questions beginners ask is, how much money do I actually need to get started? The answer surprises many people. You don't need thousands of dollars before you begin. Thanks to modern investment platforms and fractional investing, many people can start with a relatively small amount. What matters most isn't the size of your first investment, it's building the habit of investing consistently. Imagine two people earning the same income and living similar lives. One keeps waiting until they have enough money to invest properly. The other starts with a small amount and contributes regularly every month. Years later, the difference between them isn't luck or income, it's that one began earlier and stayed consistent. Rather than waiting for the perfect moment, focus on creating a habit you can maintain. A simple way to do that is to pay yourself first. Set aside a fixed percentage of every paycheck before spending on non-essential things. Better yet, automate it. When investing happens automatically, you're less likely to let emotions or market headlines interrupt your plan. The exact amount will be different for everyone. Some people can only invest a small portion of their income, while others can invest much more. The important thing is choosing an amount you can comfortably repeat month after month. As your income grows or your expenses fall, gradually increase your contributions. Let your investing grow alongside your financial life. Remember, successful investors aren't defined by how much they invest on day one. They're defined by how consistently they invest over time. Starting small today is far more powerful than waiting for a perfect future that may never arrive. Next, we'll walk through exactly what happens after you press the buy button, so you'll know what to expect when making your very first investment. For many beginners, the most intimidating part of investing isn't choosing a fund. It's clicking the buy button for the first time. Until you've done it once, the process feels much harder than it really is. So let's walk through it together. You open your investment account and transfer money from your bank. Whether it takes minutes or a few days, your money is no longer just sitting idle. It's preparing to start working for you. When the funds arrive, you search for the investment you want. You choose how much to invest, not a perfect amount, just an amount you're comfortable starting with. Next, you confirm your purchase. For most beginners, this is as simple as selecting the default option that buys at the current market price. A summary appears on the screen. You check the investment, the amount, and the total cost. Everything looks right. Then you click buy. For a brief moment, nothing feels different. Then you realize something important. You're now an investor. That feeling quickly gives way to a quieter realization. The hardest part wasn't understanding investing. It was taking the first step afterward. You'll see your investment move up and down with the market. Some days it will rise, other days it will fall. That's normal. Investing isn't measured over days or weeks. It's measured over years. The real milestone was never buying at the perfect price. It was having the confidence to begin. And once you've done it once, something changes. The uncertainty fades, the fear loses its grip, and every future investment feels a little more familiar. Next, we'll simplify one topic that many beginners either ignore or overcomplicate: investment taxes. You open your investing app. Your portfolio is green. It's worth more than when you bought it. Then a thought suddenly hits you. Do I owe taxes on this already? The answer in most cases is simple. Not yet. Let's see why. Imagine Alex invests $1,000 into a diversified fund. Over time, it grows to $1,300. Alex is happy but hasn't sold anything. Even though the investment has increased in value, Alex usually doesn't owe taxes yet. This is called an unrealized gain. The money has grown on paper, but no taxable event has typically happened because nothing has been sold. Now, imagine Alex later sells the investment for $1,300. The $300 profit is called a capital gain, and that's usually when taxes may apply. In many countries, investments held longer receive more favorable tax treatment than those sold quickly. Some investments also pay dividends, which may have tax implications depending on your account and local tax rules. There are also retirement or other tax-advantaged accounts designed to reduce or delay taxes, allowing your investments to grow more efficiently over time. But don't overcomplicate it. The most important idea is surprisingly simple. Holding an investment usually isn't the taxable event. Selling it is. If you remember that one rule, you've already removed most of the confusion surrounding beginner investing taxes. Taxes matter, but they don't need to stop you from getting started. In fact, the biggest cost for many people isn't taxes at all. It's waiting too long to begin investing. Next, we'll look at the most common beginner mistakes so you can avoid them before they cost you time and money. Learning how to invest is important, but avoiding common mistakes can be even more valuable. Most beginners don't lose money because they lack intelligence. They lose money because emotions quietly take control. Imagine one new investor. At first, they're excited to begin, but they keep waiting for the perfect time. Weeks become months, and hesitation quietly turns into missed opportunity. Eventually, they invest, but now they feel behind. Hoping to catch up, they pour money into a trending stock instead of building a diversified foundation. Then the market falls. They open their app expecting reassurance, but see red instead. They refresh the screen, close the app, open it again. A normal market dip suddenly feels like a huge mistake. Trying to fix the situation, they sell and wait for things to feel safer, but the market recovers without them. Frustrated, they chase the next hot investment they see online, only to discover that much of the opportunity has already passed. A pattern begins to emerge. Every mistake came from the same source, letting emotions make the decisions instead of a long-term plan. Successful investors feel the same fear and excitement as everyone else. The difference is that they don't let those emotions control their actions. They step back, return to their plan, and stay consistent even when markets become unpredictable. Investing success isn't about making perfect decisions. It's about avoiding the emotional reactions that can undo years of progress. That shift from reacting emotionally to acting with discipline is what separates beginners from long-term investors. Next, we'll bring everything together with the mindset that helps wealth grow steadily over time. After everything you've learned, you might think successful investing is about finding the smartest strategy. In reality, it comes down to something much simpler. Consistency beats complexity. Imagine two investors starting on the same day. The first checks the market every morning, follows financial news, and constantly searches for the perfect time to buy or sell. They feel busy, informed, and in control. The second sets up an automatic monthly investment into a diversified fund. They don't chase headlines or try to predict the market. They simply invest the same amount every month and get on with their life. Years later, something surprising happens. The second investor has quietly built more wealth, not because they were smarter, but because they stayed consistent while the others stayed busy. That's the lesson many beginners miss. The market will always have periods of growth, downturns, and uncertainty. Successful investors aren't the ones who react to every headline. They're the ones who keep following their plan through all of it. Wealth also grows much more quietly than most people expect. It comes from investing part of each paycheck, repeating the same simple habits, ignoring short-term noise, and giving time and compound growth the chance to work. Once you understand the basics, success is no longer about learning endless new strategies. It's about doing a few simple things consistently. Your greatest advantage isn't predicting tomorrow's market. It's giving your investments enough time to grow. Building wealth isn't about one brilliant decision. It's about making simple decisions again and again and staying committed even when things feel uncertain, and those decisions begin with your very first investment. Next, we'll turn everything you've learned into a simple action plan you can follow this week. You've now learned the foundations of investing. You understand why saving alone isn't enough, how investments work, how to build a portfolio, and the mindset that creates long-term wealth. Now the question is simple. What should you actually do next? Think of this as a short journey you can begin this week. Tomorrow, spend 10 minutes reviewing your finances. Know your income, your essential expenses, and whether you have an emergency fund. A strong financial foundation makes every investing decision easier. Next, choose a reputable brokerage and open your investment account. Don't spend weeks comparing every platform or waiting until you feel completely certain. Progress matters more than perfection. Once your account is ready, decide on a monthly amount you can comfortably invest. It doesn't have to be large. Starting small is often the best way to build a habit you can maintain through every kind of market. Then choose a simple, diversified investment that fits your long-term goals. Avoid chasing trends or constantly changing your strategy. Simplicity removes confusion, and consistency removes emotion. Finally, automate your investments whenever possible. Instead of deciding each month whether to invest, make the decision once and let the habit continue automatically in the background. Remember, your first investment isn't meant to make you wealthy overnight. Its real purpose is to begin a habit that can quietly grow for years. Every experienced investor once stood exactly where you are now, wondering if they were ready. The difference wasn't that they knew everything. It's that they eventually took the first step. And by reaching this point, you're not starting from zero. You're starting with clarity. Next, we'll bring everything together with one final lesson that could change not only how you invest, but how you think about building wealth for the rest of your life. If you've stayed with me until this point, you already know more about investing than most people do before they ever open their first account. But if you remember only one thing from this entire guide, let it be this. Building wealth isn't about making one brilliant financial decision. It's about making one good decision over and over again. Many people think successful investors have secret knowledge or extraordinary intelligence. In reality, most long-term wealth is built through simple habits repeated consistently. Investing regularly, staying patient during market downturns, ignoring distractions, trusting a long-term plan instead of reacting to every headline. There will always be people promising shortcuts, guaranteed returns, or the next big opportunity. Those stories attract attention, but they rarely reflect how lasting wealth is actually built. The investors who quietly succeed usually follow a much simpler path. They save consistently, invest regularly, stay diversified, keep costs low, and give compound growth time to work. Don't worry if your first investment isn't perfect. Almost nobody's is. Don't worry if you can only start small. Every large portfolio began with a first contribution. And don't wait for the perfect moment. It rarely arrives. If there's one action I'd encourage you to take today, it's this. Open your investment account. Make your first contribution. Begin. Years from now, you probably won't remember today's market price or the headlines you read, but you'll remember the day you stopped being someone who only watched and learned and became someone who actually began. That is the real turning point. Thank you for watching, and I hope this guide gave you the confidence to start your investing journey. Your future wealth begins with the habits you build today.